Price action is easy, actually. I will show you in an easy way to understand, step by step. Even traders that just started will understand. It's crucial because price action is the secret of profitable traders, so let's get started. To master price action, we first need to make sure we understand the fundamentals of the candlestick. The candlestick contains the body and the wicks. When a candle has buy-side pressure, the lower beginning of the candle's body is the candle open, and the higher end of the candle's body is the candle close. That means that this candle has opened at a lower price and has closed at a higher price, obviously representing a price appreciation. The wicks represent the maximum price levels that a candle has reached, but not closed at that levels. In the case of a bullish candle, the higher wick represents the highest price this certain candle has reached, and the lower wick represents the lowest price level this candle has reached. And in the case of the bearish candle, when a candle has sell-side pressure, the higher beginning of the candle's body is the candle open, and the lower beginning of the candle's body is the candle close. So in this case, it's the opposite of the bullish candle. That means that the price has opened at a higher price and has closed into a lower price, showing a depreciation of price. In the case of the bearish candle, the wicks work the same way. The higher wick is the highest price level this candle has reached, and the lower wick is the lowest price level this candle has reached. These are the fundamentals of the candlesticks. Every trader needs to know this because this is the base of the price action. This is just the surface level of the candlesticks. We will talk more about variations of candlesticks with a high importance in price action analysis. But before that, we also need to understand what even is price action. Price action is not a strategy itself, but it's the activity of analyzing how the price has moved. Understanding recent price movements can be very helpful in increasing the probability of understanding what is the possible upcoming move. Could the market go to the upside or to the downside? Most of the times, it's not 50-50 chances, but one way has a higher probability than the other, and price action is the base of being able to analyze that opportunity. We learned about candlesticks before. Well, price action is simply a presentation on a chart of multiple candlesticks. The two charts we have right here show the action of how the price is moving. For instance, in the first chart we have a market that is appreciating, with more upside bullish candles forming compared to downside bearish candles, which are less in this structure. And on the second chart, it is exactly the opposite way. There are more downside candles than upside candles, showing the depreciation of the market. This is the surface basic level of price action. Now we are going to dive into more details. The first more complex and important concept we need to master is market structure and trends. Market structure is a concept of identifying the two types of market movements. There are trending markets, which are the uptrend, and the downtrend, and the other type of market movement is the consolidation, starting from the trending markets. The uptrend is a price structure that increases over time. This is often known as a higher high and higher low formation. So for an uptrend to be confirmed, each high has to be higher than the previous high, and each low must be higher than the previous low, when the price breaks a higher high and forms a new higher high. This move is called a break of structure. The break of structure is an indication that the market is continuing and respecting the already set trend. So if the market pulls back down after creating that new high, and the pullback ends up higher than the previous higher low, so price can then push to the upside and break the recently made high in order to create a new higher high. That is another break of structure. Now this price structure is textbook perfect and rarely happens in the real markets. Moving into a more realistic price action structure that you will likely see on the charts, it would look more like this. So it's slightly more complex. The most important detail we need to master are swing levels. Swing levels are the extreme highs and extreme lows of a price movement. For example, at the beginning of this price structure, we got the swing levels from the past structure that are easy to identify. This is the higher high, and this is the higher low, but the upcoming structure is a bit more complex. So after forming a new higher high with its respective break of structure, the market goes down. But is this higher low? Well, no, because what we care the most about is the swing levels. And the swing higher low is the most extreme low of the price structure, which is this one. This leaves us in differentiating the two types of structures. There is external structure and internal structure. The external structure is the price structure seen on the high time frame that respects the main trend. In this case, if we would only take external market structure into consideration, the market moves like this: a push to the upside, a pullback to the downside, another upside movement, move that breaks the last high, forming a new higher high. Therefore, a break of structure. Then the market pulls back down after it formed that new high, and formed a new higher low, because the pullback ended above the last higher low. And then we got another upside push, move that again breaks the last higher high, so it forms a new higher high, so again another bullish break of structure. Then the market does the same thing again, pull back to the downside, higher low formed, push to the upside, new higher high and break of structure. Now what is internal structure? The internal structure is the price movement that happens on the high time frame but is seen by zooming into the lower time frame. For example, if we take internal structure into consideration, this whole downside movement is the internal structure. The internal structure usually goes against the high time frame trend, because the internal structure is seen by a pullback here, and a pullback on the uptrend is nothing but a low time frame downtrend, a downtrend that is set for a trend reversal after forming the external higher low. Don't worry if this seems more complicated, because we are going to cover it all, and especially on the chart. Now for the downtrend being the second trending market movement, the downtrend is the price structure where there are more sell-side bearish candles compared to buy-side bullish candles, making the price holding a constant depreciation. The downtrend formation is popularly known as a lower high and lower low formation. Each swing high is lower than the previous swing high, and each swing low is lower than the previous swing low. On the downtrend scenario, when the price approaches the lows and breaks them down, forming a new lower low, that move is called a break of structure, so it's the opposite way around to the uptrend situation. So to not confuse these scenarios, remember that a break of structure is a confirmation that the market moves towards continuation of the trend that has led to that price level. In this case, the trend that has led to this level is a bearish trend, so a downtrend. That means a break of structure indicates the continuation of the downtrend. But as I said before, this is a perfect example that it's rare to meet on the market. A real market following a downtrend would look something more closer to this price structure. On the left of the price action, it's simple to read. We got a lower high, with a push towards the downside forming a lower low, then a pullback to the upside, pullback that ends lower than the previous one, meaning that this is a set lower high swing level, then a break of the past lower low, which forms a new lower low and very important a break of structure. And now the price action is becoming more complex. If we would take only the external structure into consideration, the market would now pull back to the upside, form a new lower high, then break to the downside forming a new lower low. So it's exactly the same move we had before, and the same move that we have shortly after. Now if we would take only the internal structure into consideration, the price action would look more like this. This straight downside movement would actually look like a price action that keeps forming the downtrend formation of lower highs and lower lows. And when the upside pullback comes, the price action would actually form an uptrend structure with higher highs and higher lows. So keep in mind, on high time frame downtrend, the pullbacks are low time frame uptrends. Now, why is this important to know? Well, because we will later talk about trading with the trend and trading against the trend. And for that, it's crucial to understand market structure and price action. So let's jump into the charts and apply all the price action that we've talked so far. The market started off with the upside movement, followed by a small downside pullback. The pullback sets a higher low formation. And because the past high has been broken, this forms a new higher high. The new high got broken to the upside shortly after. Remember what indicates a break of new highs on uptrends? A break of structure, and what a break of structure indicates. It indicates a trend continuation. And what this pattern follows? It follows an uptrend. So after breaking the highs, the market kept holding a pretty significant bullish move. That move has ended higher than the last move, which in itself means a formation of higher highs, followed by again a small pullback. Pullback that ends higher than the previous pullback. That means a new higher low formation, followed by a small impulsive upside push. Push that also manages to break the new highs once again, Remember what that indicates. A break of structure. After the break, the market continued the bullish momentum, increasing the price to finally end the move. Ending which is formed by a higher high with an upcoming pullback. A pullback that also ends higher than the last pullback. So we got both swing levels being higher than the last swing levels. That means we got new higher highs and also new higher lows. Followed by another constant push towards the upside. Push that end ups higher than the last upside movement, which is then followed by a pullback towards the downside. And again, pullback that ends up higher than the last pullback. So we see the same price action pattern of break of structure from breaking highs, with higher highs and higher lows. Now here it's more interesting, because we have a very nice internal structure action. So if we see the price has moved up initially, then pulled back to the downside, notice that internal pullback ends up higher than the external pullback, which forms the first internal higher low, followed by a move towards the upside, move that does not break the last external swing high, but it does break the last internal high. So in this case, we got an internal break of structure instead of an external one. This is very important for traders that look for counter-trend setups. We will later talk about their impact. But now look at this interesting move. Normally we would expect a pullback that forms a higher low in uptrends, but this low has broken down and formed a lower low. Now this is what's called a liquidity grab or liquidity sweep. It's basically a manipulative move to trap traders. A simple way to avoid these liquidity sweeps is to first have patience to look at the next upcoming candles. If the candles move down and break the external lows, then we would worry about a trend reversal. But in this situation, if we applied patience, we could have easily noticed that that was a trap, because shortly after that wick to the downside, look what happened next. It broke the internal highs. So basically, it continued the initial internal trend, and also it continued the initial external trend, because it broke upside to new external highs. So it formed new higher highs. So another bullish break of structure. Also, if we would take only the external structure into consideration, the swing external move would look more like this. After the last higher high and higher low formation, the price pushes directly into new higher highs, and followed by another pullback, which forms a higher low. So this is how we read price action on uptrends. Now we need to talk about trend reversals. Trend reversals or trend changes is the price action move when the market deviates from its initial trend and starts moving towards the opposite side of the initial trend. For example, let's say we initially had an uptrend. As we know, the uptrend is a price action formation with constant swing higher highs and swing higher lows. We know that each break of new highs creates a bullish break of structure. So the opposite side of moving up is obviously moving down. The trend reversal has three main targets. The first target is breaking down the last swing higher low, which forms a new lower low. This first break of the last swing low level is called a change of character or a market structure shift. To this would be the first break of structure that happens to the opposite side of the initial trend, so it's easier to understand this way. The second target is for the price to pull back to the upside, but being unable to break the last higher high, so this itself forming a new lower high, and the third target is breaking down the last lower lows again, forming new lower lows. And now we got a bearish break of structure. So when this price action pattern has been formed, the trend has confirmed a reversal from an uptrend to a downtrend. And the most likely price action scenario is for the same pattern to keep printing. So a pullback to the upside, break of the lows which forms a bearish break of structure, and so on. This pattern keeps forming until we get a trend reversal again, but this time a reversal from a downtrend into an uptrend. And that is done by price breaking up the previous lower high, which forms a new higher high. This being the first target that prints out the first reversed break of structure that's called a change of character or market structure shift. The second target is when price pulls back to the downside, but does not break the previous lower low, which creates a new higher low. And the third target is when price pushes up towards the upside, breaking the highs, so forming new higher highs with a followed break of structure, and this confirms an uptrend, with the scenario that the market is now looking to form an uptrend with higher highs and higher lows. Now we can apply it on the continuation of the chart. We can easily see how the higher high and higher low kept forming for one more time, and soon after. The price went down towards the lows, breaking the last lows, and forming new lower lows. Now keep in mind, this has happened during a trend that up until this level it was following an uptrend. And now the market broke down the swing lows for the first time during this price action chart. The first reverse break is the change of character. So we have reversed from an uptrend into a downtrend. With the presentation, the whole price action would look like this. Push to the upside, pullback, push to the upside, breaking the last highs. So basically an uptrend structure. Then the next pullback actually breaks down the last swing low, which in itself forms a new lower low in an uptrend. So that means that this indicates a change of character with its trend reversal into a downtrend. Downtrend that is characterized by simply forming lower highs and lower lows constantly. That happens until the trend reverses again. And from a downtrend into an uptrend, the trend change is done by breaking the last swing highs and forming new higher highs, followed by a pullback to the downside that ends up higher than the previous pullback's low, and finally followed by a new break of the highs. And this pattern constantly repeating until again we meet another trend change. Also need to make sure we don't forget to draw the swing levels. Here we got the lower low, and here the lower high. And from the new lower high, price shortly went into sustained downside movement after movement that ended breaking down the last swing lows. So what we've got is the first bearish break of structure. So after the break of those lows, we had the same price action pattern again. Pullback to the upside that ends up lower than the last pullback, which is followed by a push to the downside. And again, move that breaks the last swing low, basically forming a new swing lower low. And don't forget about the lower high as well. And we carefully mark them with its respective bearish break of structure. Now pay attention of an interesting price action. So after the last lower low, we got an internal upside price action. The first internal move formed an internal high, then pulled back down. If we see the internal low is higher than the external low, but this external low can also be considered as an internal one, followed by an upside movement that breaks the last internal high. And the next pullback is supposed to end higher than the last internal low, but in this case, just like in the past example, we've got a liquidity sweep that wicks down and instantly reverses to the upside. We also need to pay attention of the recently broken lower high on the external structure. Remember that the first swing high broken up in a downtrend is the first indication of a reversal into an uptrend, and that indication is a bullish change of character. Also make sure to draw the swing levels so we don't get confused. Here we go, the lower low and the higher high from which externally the market pulls back down, forms a new higher low externally. So we mark the higher low. And from this level, we got the final push to the upside. A very aggressive uptrend started from the bullish change of character that has done its job of indicating a trend reversal. Now we're diving deep into candlestick patterns. There are so many candlestick patterns, but just a few of them are actually useful. So we won't memorize them all, but we will just learn logically, and it's easier to interpret. So keep this in mind. The larger the body of a candle, the higher the momentum and chances for that move to continue. And the smaller the body of a candle, the higher the chances of the next candles reversing to the opposite side. A small body indicating a decreased momentum. This is basically all the logic we need to understand because patterns just follow this rule. For example, if we got fuller body upside candle, there could be a higher chance of the next candle being a buy-sided bullish candle. This is what actually forms an uptrend. And when the buy-side bullish candles start forming smaller body upside candles, this often leads to a reversal into a downtrend. The downtrend itself respecting the same rule under opposite side candles. So the fuller the body of the sell-side bearish candle, the higher probability of the next one's continuing sell-side bearish candles. And this forms a downtrend. And the process repeats itself. Smaller body sell-sided candles into fuller candle body of an upside candle reversing into an uptrend. To see it more clear on a chart, let's quickly jump into a random quick look. Pay attention on the push to the downside on the left on the chart. Look at the final candle. It closed as a bearish candle but with a wick to the downside. The lower wick shows that the market has hit that price level, but the level has been bought back up by buyers, making the candle close higher than its lowest price. And just on the next candles, the buyers took control over the market. With the same logic, a lower wick that has been bought back up. But this time, it closed as a buy-side bullish candle, so it's even more positive for buyers than the past candle. Similar wicks can be seen on future candles as well. But observe closely how on the end of pullback it often prints these type of candles with a lower wick. This would be the second one in this chart, from which the price respects the short-term reversal into an upside movement. And look at this candle. The same type of candle once again on the end of the pullback. We have even more of this type next to it. As I said, this signals that the sellers are losing control because they don't have enough strength to push the market down. But instead, the buyers are taking control by buying the wicks back to the upside. Now, before moving forward, we need to have a basic understanding of what is a consolidation. So far, we've talked about trending markets, which are the uptrend and the downtrend. But there is another type of market movement called a consolidation. A consolidation happens when a price action does not set new swing highs, and it also does not set new swing lows, making the price move into a repeated up and down swing cycle, without a clear trending move. The consolidation is a period when there is not enough volume from both participants, sellers and buyers, but one of them are loading and preparing positions, and this sideways market breaks either to the upside forming an uptrend, either to the downside forming a downtrend. So the consolidation is just a market structure with indecision. This is all that we need to know so far, because we will apply this logic into the next chapter. The supply and demand, when price is following a consolidation being in a confused market state, when the price goes down into the swing lows, buyers bring the price back up because they see the price as a discounted price. And when the price moves towards the swing highs, traders start selling the market because they see it as a premium price to sell from, expecting a lower price somewhere in the near future. And this is where the supply and demand comes in. If the buyers have more strength than the sellers, price breaks the consolidation to the upside to look for more liquidity to absorb into the market. Now, we don't trade the initial breakout because that would be like trying to predict if the breakout happens to the upside or to the downside, and we don't know where it will break out. And the second reason we don't trade this is because we might be buying already at a high enough price, so potentially having a low quality setup. What we actually look to do is to wait for price to eventually come back down near the discount zone. This being a higher quality setup since we are buying at a lower price, and we are looking to take the price to break into new highs, basically forming an uptrend price action. But why does the price usually pulls back down before going higher from a demand? Well, that's because it can't get enough demand and liquidity from the maximum highs. And exactly the opposite way applies for the supply. Market moves sideways into a consolidation between discounted and premium price. Traders see the premium price as a good level to sell from. And if the sellers have more strength, the price eventually breaks the consolidation to the downside. And because there isn't enough liquidity and supply from the maximum lows, the price eventually comes back to the upside to get enough liquidity and traders' interest in opening sell positions, action that drives the market down into new lower lows, basically forming a downtrend price action. This entire logic can be applied into trending markets as well, and it's the trending markets that we will probably see most of the time, because the market is constantly moving from bullish order flow, forming higher highs and higher lows with their demand or discounted price levels being situated on downside pullbacks, and moving into bearish order flow, forming lower lows and lower highs with their supply or premium price levels being situated at the upside pullbacks. And now it's time we apply it all on the charts. So the way we identify supply and demand zones is simple. So many traders complicate it so much when all we need is the fundamentals. The demand is the last candle before an aggressive move to the upside. The demand zone is drawn from all the candle, wicks included, and moved as a zone to the right of the chart. This is the demand zone where we wait price to hit once for us to look for buying setup opportunities to take the price into new highs. And the supply is the last candle before an aggressive downside movement. This zone is often a level where price hits it to accumulate more liquidity, level where we look for sell short setup opportunities to take the price into new lows. That's all about supply and demand identification. So let's look at a backtest trade that you can test yourself after this video. So we got a very aggressive push to the downside from a volatile bearish candle. Remember the supply. The supply zone is located before the last aggressive candle that makes or breaks a trend. So the supply zone is this entire block. Now we are able to see on the right of the chart that the price actually has hit this supply zone. But also remember the logic of the supply and demand zones. Because of the lack of liquidity and positions to take from the traders, the price slowly pulled back to the upside, basically creating an internal uptrend. We can also see the lack of volume from the very small size candlesticks and kind of weird looking wicks. This kept going on until the price has finally moved into the supply zone. Right after entering the supply, the price started consolidating. Remember that the consolidation is a preparation stage for a big movement. And since the price consolidates inside a supply zone, the more likely scenario is for the consolidation to break to the downside, which we can see that it did. And it also applies the external price action logic that we've built in this video. For example, remember that a downtrend is a price action that forms lower highs and lower lows. And if we look closely, the price has broken down below the last swing external lows right after filling the supply zone. So basically, a downtrend has been either created or continued externally, and you should be able to easily spot the swing formations. Pretty clear lower highs and clear lower lows. So a setup opportunity on supply zones looks something like this. Sell short on the bottom of the supply zone, with stop loss around above the supply zone, and take profit below the swing lows if the risk to reward ratio is not too high. And in this case, it's a great risk to reward. And the position closes as take profit right here. Now keep in mind, if the risk to reward ratio would have been above 1 to 5, I would have placed the take profit slightly higher because I personally don't like too high ratios. Into the next backtest example. So here visually we see a formation of a downtrend, basically making lower lows and lower highs. Of course externally on swing levels that is driving the price down. Let's carefully mark all the important swing levels. So we got a series of swing lower highs, with a series of swing lower lows. Now on the most recent price action, we got a break of the recent swing highs, by essentially breaking to the upside with increased momentum. This break is important because as we remember, the first reverse swing break is a change of character. And a change of character indicates the reversal of a trend. And what trend was the market following up until this level? It was following a downtrend, so the reversal would be to an uptrend. But as we said before, the change of character is not really a confirmation, but rather a first sign that the market has a high probability of a reversal. It's also fine to consider the first break, but sometimes they can lead to being a false break, just to continue back down into the downtrend. So a great way to validate a trend reversal is to wait for the first break of structure. At the same time, we can look, where did the pullback ended? The answer is often from a demand zone. And if we look closely on the previous candle from the impulsive one that started this upside push, that is a demand zone candle. And price pulls back down into the demand and continues the small uptrend. Also, we make sure to mark the swing levels, so we got higher highs and higher lows. And now that the last highs got broken, we can look for the same price action pattern, because the uptrend has been validated. So the last candle before the impulse is this one. That becomes the new demand zone. And of course, the break of structure. And because this is a confirmed uptrend, we look for upcoming new breaks of structure. So basically looking for buy-long setups to take the price higher. So the entry on the top of the demand, stop loss below the demand, take profit above the highs, while also looking for a decent risk to reward ratio. And position has been closed with a take profit. I will show you in this example why I insist in following the trend. This is a trade one of my followers took, and we analyze it on what mistakes could have been avoided. So initially, we see bullish breaks of structures, and basically an uptrend price action of making higher highs, with their pullbacks forming higher lows. We mark each important swing break of structure. Now from this swing high, the price actually started to move pretty significantly to the downside, and formed new lower lows. That means that it broke down the last swing lows, so it changed character externally, from a bullish market into a potential bearish market that is followed by a pullback to the upside and a small push to the downside, which is the most recent move we can see. Now, because there is a high chance that this is a downtrend, and we also see formations of internal lower lows on the last swing external level. The odds are for the market to continue its downtrend by forming lower highs and lower lows, all the way into a new external bearish break of structure. But some might see that the price moved to the upside recently, and might take into consideration a demand zone from this candle, that candle being the last candle before the impulse that caused the internal uptrend, which is actually just an external pullback. The traders that see a demand zone here look to take the market to new higher highs and new higher lows. But the problem is that they didn't saw or taken into consideration the change of character and how the price action is favoring a downtrend rather than an uptrend. That, combined with how lower highs are being formed on the latest price action, increases the chances for the market to print another lower high, followed by a lower low. And that lower low breaks down this fake demand zone. The demand got filled. Now let's see what happens next. It breaks down the demand, basically stopping out the traders. That is why I don't like to trade against the trend, and this is why it's important to properly identify the trend the market is following. And that's essentially all the important price action concepts. Trading is complicated for most traders, but it can be simplified. On the link in the description, you have my resources that include all the effective details all explained so anyone can understand. And also, we got an ebook on how to stop destructive trading behaviors. It's basically about psychology, because we probably know by now that trading skills mean almost nothing without the right mindset. And also feel free to leave feedback in the comments and have a great trading session.